Okay, we're going to start today by looking at the S&P 500. You can see that the S&P is well above the 200-day moving average, 150-day moving average, the 100-day moving average, and currently above the 50-day moving average. So by all means, it has some momentum right now. And you can see that its stochastics are around 64. So that's a little bit overbought. It's halfway. If we go back and look at the stochastics, we can see, and when we draw the lines, the channel lines, it's basically right in between the two channel lines. So we don't know if it's going to go up or down right now. But being at 64, it's kind of overbought. So I guess it's going down. We're in February. So we do have momentum here until the S&P 500 drops below this black line. It will most likely continue in the uptrend. So let's look at the meeting notes. Right now we're in February. February traditionally has been one of the worst months of the year. The average stock market returns for February is around 0.29%, which is the third lowest. August and September are the other bad months. So we have most of the earnings. Let's say maybe half the earnings in the S&P 500 are over. We're going to have the other half of the earnings in the next couple of weeks. The only major tech stock that didn't report yet is NVIDIA, and it's reporting in the 26th of February. That's next Wednesday, two Wednesdays. So 2.5 weeks from now. All right. So the other thing we have to look forward to is in February we have President's Day as a holiday. So usually markets are decent around holidays. And we have the Fed meeting again in March. We don't know if it's going to raise or lower interest rates, but that's usually a catalyst for stocks. All right, so let's look at some more of our talking points. You can see the 10-year has been going down for the last couple of weeks. And when the 10-year goes down, that's usually good for the stock market. And we'll see a little bit later in our talk that the president and the new Treasury, their goal is to get the 10-year down without the help of the Fed. So we'll see if they do that. We have to plan accordingly. If the new administration wants the yield of the 10-year to go down, we have to look at what investments might be good in the next 4 years for that kind of scenario. All right, so let's look at some more of our talking points. We're losing momentum in the stock market. You can see we only have 49% of the S&P above the 50-day moving average and 57 above the 200-day moving average. So that last week it was 60%. We're basically unchanged from last week. And let me see. Okay, for the 10-year and the 2-year, it's down 0.5% and unchanged. So there hasn't been a whole lot of movement in the 10-year, but we know it's going down based on the chart I just showed you. All right, so we always keep track of catalysts for the market to go down. Right now, one of the biggest unknowns in the market is tariffs. And we'll talk about that later, but Trump probably will move markets daily. And we'll find out tomorrow morning that he's installing tariffs on steel imports. So that's going to shake up a lot of businesses. All right, so we're going to see that our revert to the mean that we've been talking about since the beginning of the year. A lot of these sectors are starting to do better this year. We'll review those next. All right, so here's some more of the variables in the stock market. The price of oil is down around 1.5%. It's $71. We have the dollar index is down 1%. So we have a formula as the US dollar, as the US dollar tends to, a stronger US dollar tends to drive gold prices lower, but we have a weaker US dollar tends to drive gold prices up. And that's exactly what happened. The US dollar went down and the gold prices went up because gold is priced in dollars. So that worked this week. Let's look at, um, and gold isn't directly correlated to the US dollar. However, it does affect it. Right now, the reason why gold is going up most likely is a lot of central banks are buying gold and there's a supply demand imbalance, maybe. All right, you can see that the US dollar is still in an uptrend. It's going sideways for February, but in general, it's going up. And we see from a lot of the tech earnings from this week, the rise in the US dollar up 6%, 6 to 7% in a year, in this quarter. That totally affected the earnings of Google, Eli Lilly, a lot of the major companies doing business overseas. And Colgate's another one it affected. So so a lot of corporations are saying that their earnings are negatively influenced by foreign exchange rates. So it seems like what the United States is doing with tariffs is only making the dollar stronger, which is going to make it harder for the U.S. multinationals to be profitable. All right, so let's keep that in mind. Fear and greed index. We're becoming more fearful. Last week we were neutral. So our translation is to do the opposite of what people um, are feeling. So if people are fearful, it's time to get greedy. And when people are greedy, it's time to get fearful, according to Warren Buffett. All right. And this is the first time in the AAII, American Association of Individual Investors survey, that we have a bearish sentiment. So whenever the amateur investor is bearish, then you have to start looking for things to buy. So it's a contrary indicator. All right. And the VIX is starting to creep higher, but it's still relatively low. So people aren't that fearful right now. All right. So in our emotional chart, right now we have fear in the market. And why are we fearful? We have some unknowns with tariffs, the trade war, and geopolitical issues. we had we had some stocks recently that went down, the big Magnificent Seven, because of their earnings. So we have a possible Magnificent Seven being overvalued and a lack of confidence in the AI story. We still have some market participants that believe there's China competition for AI. And all right, so let's look at our first to worst. We followed since the beginning of the year. The worst performing sector is information technology. Can you believe that? It's minus 2% year to date. Last year, it was up 37%. Communication services, it is one of the best, up 6.6%. That's Facebook. That's a lot of the Google, a lot of the mm, tech stocks fall in that category. We also have financials up the most. So as we can see from the sectors of the stock market that do well in a Trump presidency, we highlighted this at the beginning of the year, the financial sector, because of possibilities of deregulation and banks can be more profitable with deregulation. In healthcare, look at this. Healthcare is up 6%. That is on the top 3 sectors this year. This was one of the ones we were talking about since the beginning of the year as been out of favor for the last 2 years. Look at this, negative 1% in 2023 and only 1% in 2024. So it's due maybe for a good year. All right, so all right, let's look at some of the stocks going up and down today. We have Expedia, that's due to earnings. We have Supermicro, they're coming out with some kind of report on the 11th that could mention something good. There's a lot of hope that they mentioned that they just integrated the Blackwell processor into their systems. So they're going to start building out new Blackwell systems. They do AI data center work. So they're going to come out with something on the 11th, and we're going to watch that. They're pretty undervalued. Let's look at some other ones that are up and down. We have some cybersecurity firms, Fortinet, Palo Alto, and that's it. And we also have a lot of financial companies. We have Huntington. We have what other ones? No, I guess we only have one. All right. So the other ones, Principal Financial Group, they're financial. And that's all I have for the top stocks going up. One's going down the most. A lot of stocks that are home building related. Let's look at the 10-year to see if it's going up or down. It's going down. Okay, so usually if the 10-year is going down, that's good for home builders. But in this case, it isn't. A lot of home builders, D.R. Horton, Lennar, PulteGroup, the three of the biggest home builders are down over 4%, which is pretty bad. And that's all I can get from this. All right, that was a good exercise. Let's go to the sectors. We see one's doing the worst, home construction. We just saw those 3 major home builders down. We see home builders again, retail, biotech. These are all sectors that do bad when interest rates go up. So what other ones going down? We have technology, and it's going up, unchanged. That's interesting. Okay, so gold is the best sector. Gold, biotech, and gold miners. Okay, that was a good little exercise. Let's go to let me see. Check on Dan Now's picks from the beginning of the year. Okay, hold on. Okay, you can see that this ADTN pick is up 33% so far this year. Cisco's up 5%, and KBWB, the banking ETF, is up 9%. So I think I really like this one, KBWB. We're going to go over that pick actually. KBWB. These are the stocks in the KBWB. We have Citigroup, JP Morgan, Wells Fargo, Goldman Sachs. These stocks all have a low PE ratio. They pay a dividend. They benefit from deregulation, benefit from deal-making IPOs that are going to be allowed in the new administration, and they're a safe sector. Warren Buffett owns a lot of these. So we know it's going to be a good in favor sector. Let's look at the ones. Another Dan Mouse pick. Um, they're not doing. This one's not doing as well. These are IJJ top holdings, the S&P Mid Cap Value ETF, and we can see Flex LTD is up the most at 7%, and Advantor is down 11%. So I'd say this is my least favorite of Dan Mouse picks. All right. Um, okay, here's a little excursion. Tomorrow, Donald Trump says he'll announce 25% steel and aluminum tariffs on all steel and aluminum coming into America. That is huge. Um, anytime there's, we, I posted this from last week. We have stock futures plummet after Trump imposes sweeping tariffs. We had like this tariffs on Canada and in Mexico and China. Tariffs. What I highlighted here or other articles. Markets react to Trump's tariffs on steel and what what sectors could be affected? Well, what companies use the most um, aluminum and steel? We have car manufacturers, of course. They import um, steel from overseas. We also have um, airplane manufacturing. We have mm, railroad car building. Okay, so we have a lot of unknowns. One thing, one story here, it says Trump tariffs rip right through C-suites and financial models. So everything is pretty much there. Things are unpredictable whenever you start throwing tariffs everywhere. Just Ford's president just came out and said, you know, every tariff you put on steel or incoming goods from overseas, that reduces our profitability. So the market hates uncertainty. Whenever you have tariffs every day and a threat of tariffs in the future, you have uncertainty, and the stock market doesn't like that. That's why the first time this happened, the stock market went down. And I don't know what's going to happen next, but this is one of the variables that in the next 4 years we have to put up with. And we have to say, does it really affect the companies that we're investing in? Right. So fortunately, I don't think steel and aluminum tariffs affect the stocks that we're following. So that's probably good. Okay, I picked out some charts that are interesting. You can see that NVIDIA had a tough couple of weeks. It's still down 13% since there was a scare for DeepSeek. You can see that, it hit the bottom of this trend line, and, it's basically right at the 200-day moving average. And this purple line is 200-day, the green line is the 150. An interesting thing is the 50-day and the 100-day moving averages are starting to turn lower, but we have earnings coming out for NVIDIA. So we have a good pattern of a channel. These black lines are channel lines, and it didn't really break through those channels. And if we have good earnings coming out in 2.5 weeks, we might see it go up to here. And if it breaks this channel on earnings, then we're facing a new reality of a downtrend. We have a lot of momentum going into this stock. That's why um, we had a 17% sell-off. There was a lot of people on the one side of the boat. Whenever that happens, sometimes it goes down a lot whenever it turns the other way. But you can see we're oversold. We're at 30 in the stochastics. So 30 is kind of low. So I would have it. Well, right now it's oversold. So usually when it's oversold, you either start accumulating or um, just hold what you have. All right, so next one we're going to look at is Microsoft. You can see that there's a well-established sideways pattern here. We just got out of earnings, so their earnings are reported. We're oversold, and we're at the bottom of this trend line. But it's been a well-defined trend line, so there's a good chance in 2 months we'll be up here at the top. And the stochastics are 11, which is probably the lowest you can go. Let's look at another one. Tesla, you can see it's jumped way out of whack. Right now it's still overvalued, um, but you can see that it's kind of trying to go back to this pattern here we had starting last year. So it looks like next Tesla's um, could be going back into this pattern. So we'll see if it goes down to here next. But it's oversold, definitely 13 in the stochastics. Okay, so last week we had earnings come out. We had Eli Lilly had amazing earnings that came out, and they had good guidance. And we're going to go over that a little bit later. Um, Novo Nordisk had good earnings too. They sell a similar product, weight loss drug, Ozempic, and we had Alphabet. They came out with earnings, but they had a disappointing cloud revenue growth rate. So um, the interesting thing about the earnings season is all of the big tech stocks are still buying NVIDIA chips. So that is just a hint that their capex is really, really um, more than expected, and that's really good for NVIDIA. Um, and we had Palantir, they're a AI company that they had really good earnings and they gave good projections. Um, so we'll talk about some of those. Amazon came out with earnings, but they slightly missed. I'm not sure, I forget exactly what they missed at, but I think it was the cloud growth. Um, the cloud growth was 19%, and people wanted more than that, so it went down. But in general, all of the big tech stocks did really good in their earnings reports, and so they're still the big tech stocks are still growing at 20%, and whereas the regular stock market is growing like 10%. It's not as much. The other S&P 493. So um, we'll talk a little bit more about the big tech versus the rest of the stock market later on. This week we have earnings coming out. Maybe a good 30% of this S&P reports this week. Not a lot of big tech stocks. We have Cisco reporting on Wednesday. That's probably the only one to really get excited about. Most of these other companies are kind of not needle moving. All right. So, okay, we had this article came out about China's DeepSeek. The day that it came out, we talked about how I tried DeepSeek. Whenever a news comes out, you gotta like really understand it, understand the news, understand if it affects your stock. Sometimes you gotta do your own research and then look at other people's opinions to see if it'll affect the stock that you're following. And I tried a DeepSeek app. It failed some basic queries that I asked it, and I said, well, it doesn't seem like it's high quality enough to take over the video. So a week and a half later, we have some articles by J.P. Morgan. J.P. Morgan says, don't panic. The video will actually be a DeepSeek winner. So, and then we have Tom Lee. He says these DeepSeek was an overreaction, but yet still, the video is still down 13% from that news. and they have earnings coming out in 2.5 weeks. So we know that every Mag 7 name is spending heavily on NVIDIA chips too. So I'm going to go, we'll cover NVIDIA and a little bit later. Here's an article about Eli Lilly. They beat their earnings estimates when they reported on Thursday. They had upbeat guidance, surging demand for weight loss and diabetes drugs. Okay, you can see that Eli Lilly has been kind of going sideways for a year now, and it's kind of overbought. So it's not a good time to buy this one. You can see by the earnings estimates that they're growing their earnings around 28% going out a couple years. And right now their PE ratio is 38. So they're just a little bit expensive, 30% overvalued. And I looked at the statistical information. You see Yahoo Finance thinks it's 17% undervalued, a PEG ratio of 0.83. And they have a good profit margin, an amazing return on equity, and they have around $28 billion in debt out of 798. That's not bad at all. That's pocket change. And they pay a dividend of 1%, which isn't that great, but it's okay. Right, so basically, I think Eli Lilly, if you don't have, it's almost like a tech stock. It's growing at 30% a year, and it's a good way to diversify. We know that tech is starting to be back based on our, let's look at this. Okay, our worst at first. Healthcare has been bad. 2 years ago, healthcare has been bad last year. It's bound to do better this year. So it's up 6% already this year. So we're going to start looking for stocks to invest in the healthcare sector because it's a sector that's growing at 20% this year. Their earnings will be growing 20%. So as soon as we find some of these, that'll be a good thing to add to a portfolio. Okay, let's go back to our talking points. Okay, this article came out yesterday. Treasury Secretary wants to bypass the Fed to lower interest rates. In his theory, to get the 10-year interest rate down, America wants the 10-year rate down because that reduces the interest rate payments. And one way to do is for the Fed to reduce the interest rates. That's not going to happen quickly. So his idea is if we deregulate the economy, cut the taxes on the corporations, make them more profitable, and we get the price of energy down by drilling oil, that will make rates go down, and the dollar will actually go down also. Will it go down? I'm not sure what the dollar will do, but right now it's going up a lot based on what we're doing with tariffs. Ramifications of having 10-year go down purposely. Tech stocks and stocks that need to borrow money to grow will do good. High yield investments will be in great demand. So it's going to be hard to get a 10% yielding or an 8% yielding investment, like maybe some of the cigarette stocks that have a high dividend. Maybe those will do good whenever the interest rates go down. So, and REITs will also do well, also because they're higher yielding. Let's look at this article by Yahoo Finance. They had a fireside talk with Brad Gerstner. He runs an altimeter global fund, and this altimeter fund has done really well in the past couple of years. So look at 23, 24, and 25. You can see his fund returns 94, 39, and 100 69% for the past 3 years, whereas the S&P only returned 20, 20, and 53%. So what he's saying is he's betting big on technology. His theories are technology, QQQ has done much better than the average S&P stock over time. So he thinks we're right in the middle of a new um, wave of technology. In 2000, we had the internet. In 2010 to 2014, we had mobile um, phones, and that was the new technology. Then we had cloud, and now we have AI. And he thinks this is a transformational technology. Um, he says that he's surprised that a butterfly whip flapped his wings in China, which is DeepSeek, and the whole AI trade goes down 17% in a day. He thinks that his company does that research to know that this DeepSeek is garbage. So he didn't sell, he bought more of NVIDIA. And we'll show some of his top holdings later. But his big, he was well known for writing a letter to Meta 2 years ago when Meta was at 90. He believed in them, and that's why his fund is up 169%. He said you got to cut costs, and basically now they're 600. So what he said in his talk, if you watch this, um, tech is twice as profitable as non-tech. The main problem with tech is disruption, and there's a wide history of stocks that just went out of business after they were disrupted, such as some of the early search engines like Alta Vista, Excite, and Netscape. All right, so in his slides for that talk, he mentioned that the Mag 7 earnings were up 44%, the earnings, but this year they're only up 20%, and 2 years from now they're up 17%. So they're projected still to be growing about 14%, and that's still higher than the S&P because the S&P only grew the S&P 493. That's the 493 that aren't the Mag 7. That was only up 2% last year, their earnings. And they're scheduled to be only up 11% for the coming year. So he's saying that it's still a good idea to continue to buy tech in the Mag 7. Right, so let's look at some of his top holdings. You can see he accumulated a large position in Meta when it was around $90 a share. So that's his top holding right now. And you can see that makes up almost 20% of his portfolio. And look at this one. Uber is another top holding. It's the second largest holding. We're going to go over Uber later on again because we've been seeing it in our stock screener for the past couple months. So it's a good idea. We have a lot of really smart people making that a top holding, which usually is an indication that we should start looking at it. You can see NVIDIA and then Microsoft, Tesla and Amazon, Google, Taiwan Semiconductor, all stocks we're following are in its top holdings. So it seems like we're on the same wavelength. Um, so let's look at our stock screen for this week. You can see Uber again is in our top 10. It says, according to Fidelity, its PEG ratio is 0.31. That's 1/3 what it should be. But we're going to research to make sure about that. But we see the same holdings as last week, but I thought we'll go into Uber just because so many people are talking about it. We had a news story. Ackman says he amassed a stake in Uber worth $2 billion. Okay, Bill Ackman is like he's like pretty good with buying stocks that are undervalued. He bought Chipotle when there was a scare, and he that was one of his best purchases of all time. And he used to be an activist, but now he's just buying undervalued stocks. He's a follower of Warren Buffett. So I actually met him at the Berkshire Hathaway meeting last year. So I like to follow what he's doing. So we have another guy that says Uber is a good stock to buy. He said their strength of the rideshare company's management, and he says it's undervalued. Okay, he says remarkably can still be purchased at a massive discount to intrinsic value. It's one of the best managed and highest quality businesses in the world, and a favorable combination of attributes is extremely rare for a large cap company. Okay, so we're going to look at what Morningstar said. Morningstar, they say basically its price to fair value is 0.78. That's 22% undervalued. They have a narrow moat for Uber. And what they're saying is the ride-hailing industry is at a tipping point, with autonomous vehicles maybe taking over to play an increasing role. That's the one reason it's probably down so much is they might be disrupted by autonomous driving. We don't know if Waymo and Lyft and other companies are going to be um, taking over, taking a portion of their business. So let's look at what CFRA said. They said that Uber is undervalued by 22%. So that's another good hint that it's on sale. I like to look at the earnings. You can see they haven't been profitable for the first 10 years of their existence, but their earnings started getting profitable last year, and they're they're like tripling their profitability from last year. So I think what they did very similar to Amazon is they invested heavily into getting market share. They have a really big market share, and now they're starting to make the decisions to be profitable. You can see the revenue is going up in a straight line, which is just what we're looking for. And you can see the return on equity, it has been non-existent until last year. So we had 20% return on equity, now 50%. So the margins are increasing by a lot. So those are all things that we like. Um, so here, this is another CFRA comment. They have a buy, and they say our buy, this is the most important part of CFRA's report right here. It's a little investment rationale. Our buy rating indicates our favorable secular views of both the mobility and delivery segments, rising addressable market focus on AV, and believe that the company will be disciplined in cost cuts. We see Uber as a share taker with mobility trips increasing 21% in 03. And they probably meant 23. We also like the emphasis on product innovation. And so they're basically 25% of their revenues come from delivering food. So that is great. And they're growing around 25% in general. So it looks pretty good for Uber. So let's look at, let me see. Hmm, that is, let's look at a couple more things. Okay, so we have these trade war news stories where America's imposing tariffs on China, 10%. What's happening is China is threatening U.S. tech companies like Apple, Google, with probing them, and because China knows that they tariff America's goods, that's not good for their economy. So they're this might be bad for the big tech stocks. We'll have to see what happens there. Um, All right. Well, that's all I had to say for today. I hope you all have a good investing week, and I'll see you all next time.